let's just start with that. Where did Danny come from? What shaped your worldview?
So first of all, thank you for having me on the show. Great to be on, and great to do this live so that people can and everyone can join. As we're chatting. Uh, Look, I'm originally from Canada, Montreal. Grew up, my worldview or my sort of um, what drives me is I was a competitive athlete growing up, and I was a competitive tennis player. I played every sport that is out there, but tennis was where I was competitive. I would play internationally as a junior. Was ranked nationally and would play, as well internationally. And the discipline of training is just something where you whatever you did today doesn't matter when you wake up tomorrow, right? And that discipline and training and focus that is required to be a competitive athlete is something that has really just carried me with me through the rest of my life. I had an injury at 14, had to quit, so I was on a track to go, the collegiate, Division 1, that sort of route, and see maybe something from there. But when I got injured, obviously I was very focused on studies, and same thing with how I approached schoolwork, and then how I approached my career has been that. In terms of my career, I've been focused on the intersection between macro and derivatives. So I'm very fortunate to have had experiences all across different aspects of the financial industry. Um, Started out in a risk management capacity for exotic options at a financial software firm where we would advise institutional clients, pensions, endowments, hedge funds, these type of firms on their best practices of managing risk for very complicated option portfolios. And, that would be individual trade, it would be at the strategy level, it would be, at the entire asset class level, and even at the C-suite when they were looking at the entire firm, a bank or a pension fund's entire risk for the entire firm. And when you learn risk management from this way and you learn the products, in the way that I did, it has really helped me, throughout my career to always have a focus on risk. And from there, I went to, I was fascinated at the time by what was happening with the GFC, the global financial crisis. I was starting to learn about it. And I went to business school at University of Chicago. I did my MBA. I also did my CFA. Was educating myself. And to be there during the global financial crisis was just very informative for me to be able to take the macro side of things to the product side of things that I had already had that knowledge. From there, once I graduated, I was able to kind of put these two together and work in macro trading desks. So I started out at interest rate sales, covering large hedge funds, primarily on interest rate volatility trading strategies. From there, moved to another broker dealer where I was able to build an entire interest rate platform. And then since then I've worked on hedge funds in the hedge fund space, where you're a proprietary trader. You don't rely on anyone anymore. You have your own research process, your own views, and then manage your portfolio. And so going through that entire career progression, I think has been helpful. Not just having one sort of sphere my entire career, but having learned across all these different areas of the industry, just giving me different perspectives on things. So that's really what's driven me to have differentiated frameworks, today.
That's a great intro and actually gives me the focus. Usually I get to the focus of where I want to take these impromptu, unscripted narratives within the first 10 minutes. I got to it within like the first 60 seconds with you because you made the comment around the intersection of macro and derivatives. I actually have not had deep discussions yet with 54 or 5, whatever it is now, other amazing guests from this platform, specifically in that intersection. So I don't want to limit you in any way because it's as much your conversation as mine. However, I'm very keen as we get into your operating system to kind of distill for, call it, the everyday investor, the layperson, the business owner in the real world, operating in the real economy, but whose retirement or future is hedged against the financial economy, which is the bulk of my audience, right? Or the advisors to those people that are the other half of my audience. I really want to understand your lens right now on these derivatives and these macro forces and where they're intersecting, because you mentioned the GFC, and obviously that's what everybody thinks of when they think of derivatives and weapons of mass destruction. We have a lot of FUD floating around the internet. Maybe some of it's merited, maybe some of it's not, with the CapEx trade, with some of these other unsustainables. But I don't know what the derivatives world looks like and whether to be worried or not. So this is what I'd love to unpack with you. But talk to us just about the operating system at a high level, and know that where I really want to nerd out with you is, what is your lens showing you to be concerned about or not so concerned about as it relates to that intersection you kind of focus on. So let's start with the operating system and kind of what establishes the framework for your thinking as you look at risk.
Yes. Every portfolio manager, investor has their own framework. Some are systematic investors. I'm a discretionary investor where I'm doing the research on a continuous basis. It's 60% of my time, 70% of my time. I'm not a very active trader putting on, 15, 20 trades a day or anything like that. It's a couple trades a day. But I do a lot of research into the macroeconomy, and I tend to analyze it across different time horizons. So first thing that I do, is demographic analysis, and this is a big edge for me. And this is something that it's funny when I post about it on Twitter. It's probably my least favorite posts, but it's probably the most important stuff that I have done is studying demographics. So demographics is not going to tell you anything about what GDP will do this year, but it will tell you the capacity and constraints of the economy. If you have a good understanding of that, you know that growth beyond the capacity of it means that we're probably overheating or creating heating pressure, inflationary pressures. And growth below the capacity means we're cooling, and we could use some stimulus and things of that nature. We may end up with an unemployment cycle or a credit cycle if we cool for too long without stimulus. Understanding how the structural side of the economy, the guts of the economy changes from one decade to the next requires understanding these demographic forces. And so as an example, I knew as far back as 2018 that this decade would be more inflationary than the prior decade due to demographics. These things are foreseeable. You can see the nature of how the labor force and the population is changing. All of these things can be, foreshadowed with very high confidence. Now, we had in the pandemic, some of these things went, turbocharged with, the pandemic itself and the stimulus payments and things of that nature. But the nature of the cycle was always going to be quite different than the prior cycle due to demographics. So that gives me sort of a baseline framework for the economy that I expect over the course of the cycle. It doesn't tell me anything about 2026, but it tells me about the basics of the cycle. And then what I look at, to navigate, the more immediate term is financial conditions. The economy since 2010 has become very financialized. And I'll give you, an explanation why that happened. In post the global financial crisis, we had this major deleveraging by the household sector, housing busts and portfolios that took major hits and a credit crunch. And all of this meant that the traditional tools to stimulate the economy, which is lowering interest rates as low as you can, were not creating stimulus the way they normally would. We were getting borrowing because everyone was deleveraging to begin with. No one wanted to increase their borrowing when they were dealing with potentially bankruptcies or selling their house at a loss or things of that nature. So they were ineffective. The Federal Reserve decided to stimulate the economy through what we call the wealth effect. If you get asset prices up, people are wealthier. If they're wealthier, they'll spend. And so, financial conditions is effectively the transmission of policy to the markets and from the markets back to the economy. And so this is how we look at the transmission of things like monetary policies through financial conditions. So I have very detailed, quantitative framework that I use that really gives me inflection points. Inflection points on, is the economy accelerating? Do we have like very strong growth impulses, inflation impulses, or vice versa? Are we turning the corner in a downward way? These models give me a real-time look at this and allow me to tilt my, tactical exposures accordingly. And then the third time horizon is really, really short dated stuff where I have models that tell me something is rich or cheap. And I might say like financial sector is, cheap by 3%. And, I'll buy it with a short term tactical horizon of a few days to a couple weeks. So I have these three different time horizons of how I'm looking at the macro, markets. And then once I have taken done the research, done the work, and I have a high conviction view, I will then look to the derivative markets and say, where do I have an edge in expressing this? Because I'm primarily an options trader. It's what I've worked with my whole career. And, if I have a high conviction view, do I have an edge in expressing it? Now, I may look at the pricing and say I have no edge in expressing it. And then I may say it's better to wait until I do. But if I do, I will look at all the different aspects of a trade and look at, things like the forward curve, the volatility level, the volatility surface, skewness. Can I build a trade that gives me an edge in expressing my view? And then execution and manage your portfolio with discipline from there.
So, a couple more contextual questions given that, just so that people can find their own place inside of the insights that they might learn from you, even if they don't share the exact same day-to-day profession or work stream, right? So, it sounds like this is what you do full time. I know that we book this live stream after market hours because I think whether you're doing 2 to 3 trades a day or not, you are basically full-time investor is how I understand it. So, is that accurate? Yes?
Yes.
Okay.
Yeah.
So part of your time horizon is not only just on the appreciation and the accumulation side for the long term, but also whatever cash flows or whatever day-to-day needs need to be met as you build out your life and anyone who you take care of or that you are responsible for. Uh, and again, I say that because the point is some people on here are full-time investors. Maybe they're not options people. Maybe they're more value investors, maybe they're more day traders, doesn't matter. They could easily extrapolate. But for the person whose day to day maybe is running a business and passively invested through their advisor or who talks to their advisor and wants to know what questions to ask, sometimes it's harder for them to extrapolate. Where do I fit in this narrative? How is it relevant to me? So I say that because I believe there's a lot of relevance here. Demographics being one of them. I'm curious. Keep going on that thread as far as when you throw that into the chat, it's the least responded to thing. You have the two camps, people that are demographics or destiny people, and then other people that are go, oh, but we already knew that. That's not interesting, right? There's more things that manipulate or move the market. I spent a lot of time thinking about the micro side of that macro force called demographics because I've written tons about recently the $124 trillion uh, transfer of wealth that's going to change hands over the next 22 years from boomers and older to Gen X and millennials, and really the micro impact of what that does to the administration headache for Gen X's. Meaning, I take the approach of if you're Gen X, like you may not be worried about what you're going to inherit because we're the first generation that didn't expect to inherit anything, but you don't want one more thing to manage that's a nightmare, right? Because you got young kids, you got older parents, like you're sandwiched, you're in high inflation. So I look at demographics with a very curious eye around what the micro behavioral impacts are too. So how do you think about the relevance and weight of demographics today inside of your overall thesis for how you make money and how you think about the long-term wealth creation? And how micro do you get inside of that? Or is that just one macro force and you have some things that you care about there that you think people should really consider, and then that pairs with other forces that you haven't talked about yet?
So, yeah, I mean, the reason I think demographics are considered unsexy or whatever in the financial industry for the most part is people have a hard time saying, "How do I translate this to a trade?" And so I think, people say, "Okay, it's great to understand this, but how do I translate to its trade? What does it tell me what the Fed is gonna do, the Federal Reserve is gonna do with interest rates this year?" I'll give you an example of it. So, um, knowing that this decade would be more inflationary than the prior decade, there were a few core aspects that were very evident in my research prior to this cycle starting that we were going to have, and some of them have been accentuated by the pandemic. But we would have persistent labor shortages. Okay, so because baby boomers would be retiring and they were the biggest labor force group in the economy, we would have persistent labor force shortages, which meant, at a high level that as long as the economy is growing, it would be really hard for the unemployment rate to go up. It'll stay lower than it otherwise would. Wages will be a little bit higher than they would have been in the prior decade, just at a high level from the labor market side of things. You also had, for example, the savings rate of the economy. This is a very important dynamic where, let's just say you get $100 of income. In the prior cycle, we were saving anywhere between 6 to 8% of every $100 that we were getting in income. Whereas I knew that with baby boomers, the biggest savers in the economy, no longer earning income, they're no longer gonna be saving anymore. So in aggregate, the savings rate for the economy would come down. Now it's below 3% right now. Some of that is the cyclical strength of the economy, of course, but on a structural basis, we have demographics that say we should have a lower savings rate than we should in the other decade. Now, what does that mean? It means consumption runs a little bit hotter. That same $100 of income, instead of saving $8 of it, you only save, 3, 4, whatever it may be, a little bit less. That extra money is spent. Okay, so automatically we would have a little bit higher potential of growth in this cycle from that factor. Okay, and then you have other factors like millennials become the new biggest generation in the economy. So we took out the baby boomers; they're no longer in the labor force, and the millennials have become the biggest labor force group in the economy. Well, millennials are entering a really interesting period of their life where one, they hit peak productivity, right? In your 20s, you don't know much. You're really, wet behind the ears. You're learning, and you're just trying to learn from your elders, and senior people in whatever organization you work at. When you hit 40, you start to be management in some cases. You vice president, management, whatever. You start to be at your peak productivity for your life cycle. And number two, you're also in the family formation phase. So these two dynamics are also very important on a structural basis to say housing will be supported because you have millennials who will consistently buy housing no matter what, as long as the economy keeps growing. Secondly, that we'll have a higher level of productivity. So with the lower savings rate and the higher productivity, we already know GDP should run hotter than it should have in the prior cycle. Now, when you get to the more micro stuff, like what you were talking about, this is more of taking demographics and analyzing it cyclically. So what I mentioned are structural things that we should have had no matter what, this cycle played out. Now, the nature of how this cycle played out is that we have created, probably something like 70 trillion in wealth this cycle. Okay. The economy is a little bit over 30 trillion, 31 trillion or something like that. And we've created over 70 trillion, of wealth this cycle. And obviously the owners of wealth are a big beneficiary. Like the ones who had wealth to begin with compounded their wealth more than people just, came into like a lottery or anything. So what does that mean? It means the older population, the boomers, have a lot of wealth to begin with, and they've made even more wealth. And that comes into what you were talking about, where they have to do something with this wealth. So now there's a few implications from that on a cyclical basis, which is in retirement, typically in retirement, you don't actually, this is a common misconception. People think you hit 65, retire, or 70 whenever you retire, and spending falls off a cliff. That's not true. What happens is your basket changes. So, you may have been buying cars and you may have been taking vacations and you may have been going out to restaurants 5 days a week when you were working. Now you're not doing that as much, but you are spending just as much. It's just you may be spending more on healthcare, but that's still spending in the economy. And so the nature of what happened with this wealth generation is the baby boomers are actually spending far more than any demographic model would suggest they're spending. Their spending is actually going up. It's not even flatlining like you would expect in retirement. It's actually increased because they've retired with so much wealth, more wealth, and obviously there's, individual considerations, but in aggregate, the baby boomer generation is retired with so much wealth that they are going to enjoy their retirement. They're going to live and spend quite robustly, and then they also are going to help their kids if the kids need it. They're going to help them buy a house. They may transfer them wealth from their wealth, going forward. And all of these dynamics are very, very important, to understand, in the shorter time frame. But the wealth effect is something that I tweet about all the time, that it is by far the biggest driver of this economy. If you look at the markets, um, in the last week, the markets are up 5% in the span of a week, right? So if you had $1 million of wealth and you now have 5% more of that in 1 week, you're going to spend a little bit more, you know?
So
The wealth effect is driving so much of this economy.
so I wanna tie back to that intersection that you said in the beginning that you focus in on, which is macro and derivatives. And I wanna understand now with that background, where the derivative story tells you we are, because to take some of those points you just made and give you my rapid refire for you to react to. Like, yes, I think you're the right that the spending continues, it just changes the basket. That's directionally, I think, right. You would have more data on that today than I would, so I'm not gonna argue that point one way or the other, but I would tend to agree there. I think that underneath that then becomes also some of the inherent risk, right, which is assuming that all GDP is equal, which is obviously probably not a good idea. Assuming that GDP even matters as much as Roger Elhan, who I had on the show, and several others have talked about, gross national assets might matter more as far as the country's future wealth and ultimately its citizens, access to key services that it may provide, be it roads without potholes or whatever, education. So when you think about the macro boomers kind of spending shift and that wealth effect playing out now, and you think about that millennial generation coming up with different values, but similar kind of trajectory as far as they're going to be the engine. And then you think about where the derivative markets are with private credit, with other things, all of which that fixed income customer that we just spent 10 minutes talking about is betting their future on, right? Their ship has sailed. So those pension funds, those insurance funds, those fixed income products that they live on and rely on now for that income, as well as whatever wealth effect they netted to draw down on to pay for these ongoing expenses that they enjoy their golden years, can't have a systemic break. Like there can't be that story can't hold if there's something systemic that happens in the derivative market based on the greed of the last 15 years. So do you see any risk in the derivative space as it ties to these? And if so, where does it live?
I think the likelihood of us having, like, we're all scarred by the global financial crisis. I think the likelihood of us having a derivative driven, you know, issue that takes down the economy is very, very slim at this stage, based on what I look at. So when I'm talking about intersection of macro and derivatives, it's more for my trading process rather than saying derivatives are, this sort of systemic risk of the economy. I don't see anything like that. I think what we have seen is that the wealth effect, there is a substantial amount of wealth. There's a substantial amount of retail investor participation in the markets. And so there is a lot of leverage in the equity markets, in the risk asset markets. And that has a positive, it also has a negative. It accentuates the moves up and accentuates the moves down. So what we've seen is there's the old fashioned way of looking at leverage was like margin in your securities account, you know, 50% margin usage, whatever that is sort of the standard that's existed for decades. But we now have new forms of it where the retail investor is very savvy about using options. And so short dated, like 1 day, 0 day options, they don't have sort of systemic leverage because at the worst case, these trades just go to zero at the end of the day. You lose whatever you pay for them, but they can make the moves in the markets go, substantially more volatile in an intraday basis. And secondly, and then lastly, sorry, levered ETFs. And the levered ETFs have grown by something like, as of a month ago, they were very at the peak, about 150 billion of leverage has year to date, or since April, actually, I should say. April through July, you saw about 140 billion of leverage created in levered ETFs. Now, what happens when you have a situation like that is it can make the markets, go sharply higher on an intraday basis, but it can also cause the reverse. And we were seeing a pretty decent correction in certain parts of the AI theme. AI theme is obviously the biggest theme in the equity markets. And we were seeing like memory stocks, we were seeing semiconductors have very big corrections. And the leverage associated with those parts of the markets was very, very large. So the daily moves have been very large in these like pockets of the market, even though the overall market didn't move that much. These pockets were moving a lot. And so I think it's not systemic in that this could take down the market. But what it does do is say, show you a little bit of fragility for the intraday, daily, or day to day moves that can be much more volatile than people are used to. And retail investors can get badly hurt if they're using a lot of leverage. And I think the big picture is that if the markets had a meaningful correction, it would have a very big economic impact. And so that's the wealth effect that we've been talking about. You would have a very big economic impact if we had a 35, 40% equity correction, which is not unusual, to see. Every cycle typically has one of those when the cycle ends. And if we had something like that, it could actually cause the cycle to end rather than be a symptom of it. And perhaps this leverage story can just cause a cascade of losses and make people have to dump their positions. And we saw some of this with a big, famous hedge fund liquidation portfolio, a liquidation of their portfolio that happened where they had all the right ideas. They executed these ideas well, but they had too much leverage. And when they started to go against them, they got margin calls, and those margin calls meant we have to liquidate the portfolio, even though we don't want to, even though we love everything we own, we don't want to take it off. You know, that's just how it.
Yeah,
So
without
I think we're touching on a lot of things. Yeah.
well, without it being a dig, because it's not intended to be one, but I am trying to be cute and funny right now. The irony of situational awareness is he didn't have any. Like, not picking on a guy who just had a rough week, but a classic demographic example of generations that grew up where bullies existed in both and in all cases, but bullies used to come right in your face, and you could choose to back down or not, and then grudges were kept or not, and they were held and they were executed at a later date, and you didn't forget that. in a native screen digital environment, I think it's worse in some regards for a generation of people who've had to grow up without the ability to just go home and get away from it. But it also created a lack of situational awareness. And for every GameStop short squeeze victory by the little guy, um, there's an adult in the room who's been in Wall Street for 40 years ready to eat your lunch if you get too big for your britches. And that's what we saw happen. So I think without going down that rabbit hole, I want to understand because I get to talk in front of thousands of people with smart money guys like you every week, multiple times. And I get this sense that, a lot of us are not certain one way or the other. Probabilities aside, maybe, but when we look at, where this market goes, I personally I could argue 50%, it just keeps going, 50% that we're going to have that 35 to 40% correction. It's going to be horrible. And I can provide myself an aneurysm basically going through data on both sides. Do you have any sense, even if you're, are you, even if you're not afraid to be wrong or that convinced you're right, do you have any sense probabilistically, like where you think we go in the next 6 to 12 months into 2027, into 2028 specifically, as it relates to all these things that are converging and that, people are talking about, whether it's um, job loss or productivity or AI or private credit or CapEx overspend and like where do you sit probabilistically on where you think we are 18 months from now?
I can't think that far ahead. There's too much path dependency there, but I'll give you what I wrote. I'll explain to you what I wrote on Sunday to clients. So I write these big picture macro thematic pieces, but I also write a weekly note every Sunday, which is basically like, what do we have in store for us this week? What happened last week and what do we have in store this week? And I called it the playbook. And basically I said, I think after the Federal Reserve meeting last week, we had a regime change in the markets. And their credibility on inflation is very low. And it's low because they've been missing for 6 years, almost 6 years. And when Chairman Warsh was asked, how he's going to solve inflation, he basically danced around the question, like Fred Astaire. He wasn't giving anyone an answer, and the bond market was quite worried about it. Now, at the same time, turn around the next day, and equities started bouncing. And so I I look at it as, I said it basically as follows. The equity market was given a extra dose of stimulus last week that I think many people miss because yields were moving higher. And in most cases, yields moving higher is a negative for equities. It wasn't last week. And the reason it wasn't is because the dollar weakened. And the dollar weakened substantially after the Federal Reserve meeting because it was a credibility trade. If you have weaker credibility as a Federal Reserve, people dump the dollar weakens. The dollar weakening is like liquidity for equities. It is a gift for equities. So when the dollar weakens, equities could go up, even if yields are going up or staying high, and even if oil goes up. Now, on the flip side, I said, if yields were to come down or if the oil were to come down, equities are going to go aggressively higher, right? Because you have the weaker dollar, if you also get bonds bid and you get oil for sale, that equities would go aggressively bid. So far, that's what's played out in the last 2 days. But where I said that I could see the negative, I've been bullish on a fundamental basis since 2023. The reason I've been bullish at the high level was we have a very strong economy, and the Federal Reserve gave up on inflation before the finish line. And so I knew that conditions would be easy and loose, and that's conducive for equities to continue to do well. But if the bond market goes in a big way, if they lose control of the bond market, eventually, and what I mean by the bond market, I mean the 10-year yield and the 30-year yield, like they were doing last week, go substantially higher. Eventually, the front end of the curve, the 2-year yield, will catch up. And so when you see the 2-year yield catch up, if the 2-year yield starts to move to 450, 480, the dollar can no longer weaken. And if the dollar is strengthening hard, we will actually have a real correction in equities of 20, 30%. So that was my playbook is
Do you think
be low
Japan
risk.
going yen versus their bond market changes that one way or the other? Like to your thesis right now? Like as Japan was in the news all last week with, the dollar yen kind of action. Do you think that matters to your overall thesis when
It's part of it because the policymakers were basically determining, and I'm basically saying Treasury Secretary Bassett is a big part of this. He's basically saying we can't really control the bond market anymore. The bond like, we can they still have the ability to move oil around by saying a deal is close 100 times a week, even if it's not close, as we saw. But they can't control the bond market. And the bond market, if the bond market is nervous about inflation, then it's going to sell off. But the bond market could sell off even if inflation is just where it is because inflation has been high for a long time and growth is really strong, right? Like from yesterday, we got a very strong ISM manufacturing print that should be bearish for bonds. So there's multiple reasons that the bond market could be under pressure here. If the Fed is not tightening, the bond market will price that tightening ahead of time until the Fed catches up to it, right? So they've lost the ability to stimulate the economy by pushing yields way lower than otherwise they would be, right? Like a 4% tenure, a 3.5% tenure. They really cannot engineer that like they used to. So what's the one area they can engineer is a weaker dollar. And I think Besant did exactly that. I think that was his plan is to save the stock market, we have to weaken the dollar. And I think that's part of it. So whether it's the yen or whether it's other currency pairs, it doesn't really matter. It's that if the trade weighted dollar starts weakening, the S&P 500, roughly 65%, and don't quote me on this number, I could be way off. I know it's off the top of my head. Revenues for the S&P 500 come from outside the US. So if the dollar weakens by 3 to 5% in a short period of time, those revenues are just instantly flattered, right? So it immediately is positive for equities from that standpoint. It's also positive for equities from a liquidity standpoint. And so the dollar is their last trick left here. And I say that because even though they can talk down the oil market, we still have some major problems in the oil market that are not going away. Like the inventory situation is very low and you can talk it up and down, but it's not going to go to $50, because of that. I think like we're not solving these problems tomorrow. They're going to take a material amount of time to solve these problems. So what's the only real tool they have left is the dollar. So that's why I said the playbook is when the dollar rallies aggressively, that's when you get out of your risk assets. But until then, party on.
Yeah, I think I tend to probably agree with that statement around this is like their last trick. I wonder more about what impact the 10-year sitting in the high fours, almost 5 last week or whatever, right? But like what a sustained um level of that 10-year does to less liquid assets, or does it not matter? The CMBS overhang at the beginning of the year was real, on commercial mortgage paper that needed to be refinanced. A lot of things were underwater. LTVs and cap rates, are kind of there's an interesting thing that's happening in parallel is what I'm getting at, where a non-equities major asset class and call it the alternative side of both commercial, forget residential real estate right now, but commercial real estate is sitting. And I wonder how that plays out, or if you have any thoughts on that.
Yeah, I mean, interest rate sensitive sectors don't do great when the interest rates go higher. Now, that being said, the economy is very strong. We have 4.18% unemployment rate. We have GDP that was very strong in the guts of the GDP report that we got for Q2. All the trackers of the economy are very, very strong. So I think whether we're 4.5, 4.7, I don't think that's enough of a difference on the 10-year to like break anything. But on the margin, a little bit worse for housing, a little bit worse for anything interest rate sensitive. What I keep telling people though is all that matters is the equity market. The equity market has grown to be the biggest animal, whale in the economy by far, that it overwhelms anything. So we are year to date 13 trillion estimate in my estimate of wealth gains. 13 trillion. Okay. The economy is 31.5 trillion. 13 trillion in wealth created in a little over half a year. I mean, that amount of capital, and then, that was before today where we just went up another 2%, right? So the market is creating wealth so rapidly that if that doesn't turn, the economy is not going to turn. And so
Yeah.
interest rates, it just means, sorry to interrupt, it just means interest rates need to go substantially higher to equalize this, to slow this down, or we're going to overheat. If we overheat, we will eventually blow up in a big way. So that's where, if I were the Federal Reserve, do this gently now, or you're going to have to break the entire economy in 6 to 12 months and destroy everything. And you're going to cause credit losses, you're going to cause wealth losses, you're going to cause job losses at a very large scale if you have to go aggressively and hike 150 basis points in a short period of time. If you do this gently, then yeah, the equity markets will go down a bit and Trump won't be happy because he loves the equity markets. But guess what? The economy will power on. And I think that they're, sorry to say it, but shitting the bed on this.
Okay, so I'm glad you said that last part actually before I interjected, because I was gonna push back on that wealth effect from an older guy's lens. I was gonna say it's there until it isn't, right? In other words, 13 trillion is there and I can feel like I'm wealthier, but if I don't divest it, put it into something else, even if it's cash where it's mine, then it's on paper and it could be here today, gone to Maui tomorrow, right? Like it could be not there. And so I was gonna push back on that, but you kind of kept going, which I'm glad you did, and you landed me where I was trying to kind of get you to go a little deeper, which was should we raise rates or not, given the fact that um there's an argument there, right? There's an argument that we can't lower them because we'd stimulate further. We don't need to lower them right now. We need to hold here for longer. But holding isn't enough either if I listen to what you just said and if I believed you, right? So again, some people may not, they may have a different argument. I'm going to say if I believed you, holding's not enough. We're back to kind of a market dynamic where we kind of have to raise rates while we can, even if that's not something people feel like they want to hear.
Yeah, I'm so glad you asked this question. I call this passive easing. Every day that goes by that they're not hiking, policy is easing. So the best example I'll give you is I have a model for the Fed funds rate from financial conditions. Okay, so think of it like the Taylor rule. The Taylor rule tells you where should rates be based on where inflation is and where the labor market is or where growth is. Where should policy rates be? It's a simple rule. If we say 2% is the inflation target and we're at 3.4% on inflation, well, clearly we need to raise rates, right? And so I have a version of a rule like this, but it's solely based on financial conditions. Okay. Start of the year, it was 50 basis points above the Fed funds rate. It was at 4.1%. I update it every month. It's now at 5.1%. And in July, at the beginning of July, it was at 4.93%, and now it's 5.11%. So you can see that every single month. Now, of course, I'm not saying my model is the Bible, right? Like it could, it doesn't always have to be precise like that. But what I'm saying is, you can see that every month that they are not tightening financial conditions, my model is going up every single month. It's saying that there are now 6 hikes behind the curve, 150 bips. Okay, so This is why I say get started with it, do it gently. Do 3 hikes by the end of the year because there's only 3 more meetings. Do 3 hikes by the end of the year, and maybe you don't need to do 8 next year. Maybe maybe you can be gentle
You
next year.
know, the
Maybe you get lucky and be gentle next year. But if not, you're raising the risk that you're going to have to go aggressive. And if you go aggressive with this economy, you will break things. That's so passive. Uh,
Yeah, I mean, it goes back to how independent is the supposed independent Fed, and again, this is not a political statement any more than it is just you could make an argument that Powell was heavily influenced one way um, in the prior regime. You can make an argument now that Warsh might be, or they just might be, as Lynn Alden would say, victims of the fiscal train that you can't stop, right? And that shifts the power dynamic away from the person who sets the cost of money to the person who sets the pace of spending that money. And I don't know the answer. What I do know is that it's very unlikely, in Chris's opinion, that before November 3rd, anybody's raising anything anywhere. Unless you already know that you've conceded some kind of blue wave shift that you can't stop anyway, in which case you'll do the right thing in front of it. But again, that's assuming that you have that kind of leverage over the new Fed chair, and you can even enact that, right? You can tweet about it all you want, but doesn't mean it's going to happen. So I'm not in the camp that I see three raises between now and December 31st. That sounds like a prudent thing to do. So then that would mean what? 11, 8, 8 at 50, like, or a tier where you go 50 bips, or 50, 25, 20. Like, how do you do it in 2027 if you wait until January?
right. So that's where I think, well, I think that there's a few things. Well, I think Warsh clearly, you know, is influenced by Trump. And I think we saw that last week, that he talked a big game, but he doesn't want to go. And he didn't have good answers for anything on the topic of what to do about inflation. He talked about we're gonna solve it, but he didn't have any answers on how. And I think it's because of what you said, that he's influenced in that way. But he has a committee, right? He's gonna be in this job for years. And his legacy will not be determined by who appointed him. His legacy will be what he did with the economy and if he did a good job. And he has a committee there that he has to get the respect of the committee. He already had 3 different members say they wanted to raise rates. You could easily make the case for 2 to 3 more on the committee that were on the fence towards saying that they would have supported a rate hike there. So I think that if the data is strong enough, we get a labor market report on Friday. If the unemployment rate keeps going down, it's 4.18. If it goes to 4.1, that just adds to the case that you need to raise rates, and inflation, next week. But if you get more of the committee turning towards rate hikes, and he's the one who's saying no, he's going to lose the respect of the committee. So he may have to do it from that standpoint. Secondly, is what we were seeing with the bond market. Now, some of it has reversed this week, but what we were seeing with the bond market last week is if that continues to trade that way, that could force him to hike rates to regain control over the bond market. And so he may have to do it whether he wants to do it or not. And we may see that play out. We'll see how it goes. Be open minded to it. Like I said in my note on Sunday, if the bond market is not going to go, if the dollar is not going to go, if the 2 year is not going to go, then equities are going to go ballistic, like in the .com 1999 style. But the fact is he may be forced to go, even though he doesn't want to, even though he made implicit promises not to, you know, for the midterms. But I don't think that he could wait till December after the midterms if we get more action like we got last week, right? If we got to 5% on the 10-year, if we got to, 5.56% on the 30-year, he's going. He's going to stop that from continuing, because that would get very, very ugly if we lose control.
Yeah, I think, I might have a slightly different take on him, but again, it's because I sit far enough away from it where I can pretend to know more than, enough to be dangerous, but I certainly, don't make my personal living on whether a quarter bip here or there goes up or down, right? I understand it from what it could impact, and I nerd out on it, but it's not where a couple basis points changes my life one way or the other. So I say that as a disclosure. I think Warsh is the right guy in the role at the right time. Personally, I don't say that with any political bias. I think that's the right person there from what I do know about him. I think part of it might be, and this is just my opinion, it's not based on any fact. I think part of it might be distancing himself from the obvious belief that he is Trump's guy or anybody's guy, right? I think part of not doing anything is just going, you expect me to do something because you think I'm being told to do something. So I'm just going to sit here because I got three that want to raise. And maybe quietly he knows he should, to your point. Maybe what he doesn't want to do is raise, but he knows he needs to raise. He might be in that quandary because he's a smart guy. If he's got three of the however many, he needs nine. He needs six. He needs some level of like consensus moving that way. So if he's borrowing from Greenspan, who was the ultimate consensus builder, even though I have my own challenges with Greenspan, like he might be just doing that, knowing he's here to stay for a while and he's not gonna, you know, make anything happen out of his first 90 days because he doesn't have to. Right? He's not going anywhere and he could still recover. And maybe he doesn't want to. Maybe he does. Doesn't really matter. To your point, he might have to. So I think maybe from that lens, I could argue he played it right, because he's frustrating everybody, right? And at the end of the day, I agree. In the short run with you, I think the equity market matters, but the bond market dictates. So to your point, if the bond market decides we're not where we should be and 10 years go to 5.5, what matters more, the bond market or the equity market? Because the tail then wags it's not the tail wagging the dog, right? Right now, I think the tail is the equity market. It's wagging the dog because everybody's printing money at unprecedented rates. 13 trillion on a $31 trillion economy is like, why are we changing, right? Why should we not do everything? But then the dog comes back and goes, yeah, but remember me? I'm the cost of capital. I kind of matter still. Whack. And I just think we have a whole generation that doesn't understand that. I think we have a whole
I think, yeah, but I think the Fed. I agree. The bond market, if it gives a loud enough message, it'll push them. But where I've been differentiated in my opinion all cycle is saying I think the Fed needs to be paying attention to the equity market because what's happening in the equity market is not normal. It's not normal that the 10-year moved from 470 to 460 in 2 days. That's fine. That's a 10 basis point move in 2 days. I mean, oil was down, $10 in this period. That makes sense. But in that period, that alone causes the Nasdaq to go up over 5% in 2 days. Like it tells you how easy conditions are that even at 4.6%, the Nasdaq goes up over 5% in 2 days. It
Right.
is and we saw the consequences from April until now in both directions of the leverage that was created in the financial system because they're too loose. And that is dangerous. Okay. So it is dangerous if like the joke of a market right now is the Korean market, the Kospi. But it went down 40% in a month and then went up 20% in one day. Like we are not stable.
Right.
This is not supposed to be a casino. This is supposed to be investing for the future. It's not supposed to be a game where these things fly around 20, 30% in a week. This is not normal. And it is only happening because rates are too low. If rates were at 6%, you do not see this behavior. And I just
Well,
use six as an
and
example.
it's an interesting point. I want to summarize that in my way. Feel free to correct it if you think I got any of it wrong. So essentially, for plain speak, when we went from 470 to 460 in the 10-year, essentially what we said was the cost of risk-free capital dropped 1/10 of 1%. The minute we said the cost of risk-free capital drops 1/10 of 1%, which is not nothing, but not even 1%, it's 1/10, the cost of risk on assets jumped 5%. So that is a 20x move in between those two. And you go, is that normal? Is that sustainable? Well, you can sit with that question if you're listening to this, right? But what I heard you just say, there's a
Let me add to that. Let me add to that. At any point in the last 3 years, if we saw 4.6 tenure, people would have freaked out with their equities. At any point in the last 3 years, you would have seen the equity market under pressure at a 4.6 tenure. This time around, we had a 4.6 tenure, and you had the equity market go up, let's say, I said 5% in 2 days. What does that tell you? It tells you that we are too loose. We are way, way, way too loose at these rates. And if they're not careful, which I say be careful and go gently now, okay? It's better for my portfolio if they hiked 100 bips in September, okay? But it's not like, I can position for that and I would love it. But it's not the right thing to do. The right thing to do is go gentle. Keep this economic cycle alive. You want people to keep their jobs. You want the credit markets to do well. You want equity markets to just wobble a little bit or go sideways for 3 months. You don't want them to blow up. We are raising the risk that they're going to blow up and that we're going to get. This is what happened in .com. The equity market was the one that told Greenspan. You talked about Greenspan. I'm bringing him into the picture. The equity market is the one that told Greenspan that his 3 rate cuts in 1998 were a mistake. He cut rates in 1998 because of the Asia financial crisis and LTCM blowing up and all this. He cut it 3 times. The equity market, the Nasdaq went up like well over 100% after that. And he had to scramble and hike 200 basis points after that. What did we get? The Nasdaq went down 80%. The S&P 500 went down over 50%. I think it may have even been 60%. So let's avoid that because we're heading down that road where that's what's going to happen. Let's avoid that. We have a good thing here. We have a good thing. Moderate it. Moderate it.
I
The best example is if you have kids and you give them one soda, they can be a lot of fun. They have a lot of energy. They're going to run around. They're going to play, whatever, and they're going to be very fun. If you give them 4 sodas, they become a problem. Let's not give them 4 sodas. That's what we're giving the.
Yeah, I think as practical takeaways, I heard something in that last segment that you said that I want to, give to the audience to noodle on. So the practical thing is you're basically laying out what you think is the right thing to do. I think it makes sense to me, and I would acknowledge that if I was put, to a massive vote and I had to choose right now, I'd say, yeah, let's go that way. Let's do, 25 bips for 6 or 7 in a row and call it a day and let everybody get their head around it. We'll take the immediate hit, but we'll cover from it because you're given certainty. Like, let's give that forward guidance. Let's do that. Is it likely to happen? No. Does the right thing get done? Never. The right thing for whose constituents always gets done. And so if you're hedging against this, you probably do want some bet on the table, or your advisor wants some bet on the table for we screwed up, we waited too long, now we got to go 100 in one meeting. What does my portfolio look like if they decide down the road in Q1, Q2 that they got to go 100 in one meeting or 75 over 2 meetings? And it shocks everybody and we see it drop. Am I prepared for that? Probably a prudent thing to make sure that you're prepared for that scenario, because that's more probable in my 50 years of experience to happen than them doing the right thing starting next meeting. So I should have a conversation that my portfolio is balanced for a sudden rate shock the opposite way. Like, it won't probably look exactly like the one we had when we dropped in a hurry, or raised in a hurry before because, we learned from that. We had a couple of banks, we had a bunch of stuff happen when we raised too fast in the past. But raising too fast in the past to 4.5 is different than going from 4.5 to 6, right? It's not the exact same lift, but I think that's what I heard is that you have a portfolio that's saying they're not gonna do the right thing, but you're also writing about
Well,
something, writing about.
I play I I play the odds. I don't I don't make concrete predictions and get married to them. I play the odds, and I think the odds are that yields are going to continue going higher because the economy is very strong and that they're not tightening policy enough. So I'll give you some background. I said in December the economy was going to reaccelerate. They cut too much. The economy was going to reaccelerate, and we're not going to get rate cuts, and we're likely going to need rate hikes. I didn't say they will deliver rate hikes. I said we will likely need rate hikes. They're always too late on this stuff. So, I acknowledge that. But that was my view coming in. So, when we were pricing in a Fed funds rate at 275 for 2027 rates, I've been shorting that since then, and we're now, above 4% on that rate. So I put based on the probabilities of what my research takes me to and where I had an edge in the market. So I'm of the opinion that the 10-year and the 30-year are going to go much higher until they get serious. And it doesn't sound like Warsh is serious. So I don't know what that means for September. I don't play that game. I don't try to bet on individual meeting, but I thought that they should have gone 4 to 5 months ago. And if they did, they could have spaced it out to 1 or 2 hikes every 3 months. Go slow. Market might go sideways for a little bit. Not a big deal. Things would be gentle. We are getting closer to the catastrophe scenario where they're going to have to slam the brakes and break everything. We're getting closer to that. And I'm just reading the data. I'm just reading the data that is telling me that we are getting closer to that. Um, you know, People liked to say that when Warsh chose not to hike last week, that financial conditions tightened and did the job for him. He may have even hinted at it a little bit last week, that financial conditions could do the job for them in some way. Well, as we've seen in 2 days, it could fully reverse and the equity market goes parabolic. It can only be done by them. It cannot be done by the markets. The markets, there's nobody in the markets who has the wallet, the bandwidth, the budget to be able to say, I'm going to fight the direction of the market because this is what I believe. This is what has to happen because we have to tighten on our own. It's not going to go that way. It can go that way for a period of time, but for it to be sustained, it needs to come from the Fed. And so I play the odds, and the odds are play both sides. Either yields go higher or equities go higher. But the playbook, as I gave it to clients on Sunday, watch the 2-year, watch the dollar. The 10-year going up to 5%, equities could be okay as long as the dollar is weak. But if the dollar turns, equities will tank. And that is the first time I would say that I would be bearish on a multi-month horizon since 2023. And it would be because they are being forced to be aggressive. And that's what it would be. If we get the 2-year 100 basis points over the Fed funds rate, if it gets to 450, it's telling them get on with it urgently, right? The 2-year at 4.2, where it's sitting right now, is saying you should tighten, but at your own leisure. But if you get to 450, 480, it's screaming at them. And if that's the case, get out of risk assets. But until then, I don't need to predict. I can watch and I can have the playbook and say I will turn when the markets tell me to turn. And that's the framework I'm kind of going with. And I think this is a regime change, and I think everyone should kind of be on alert for it. So if you're long risk assets, your best hedge is higher interest rates or the dollar. Those are your best hedges, for on a cross asset portfolio basis. You can buy puts on the S&P also. I would always recommend hedging your portfolio. But from a relative value standpoint, you may actually win on both. You may get higher rates and higher equities. And then at some point, you just have to get out of the equities. That's kind of how I'm playing it in my portfolio.
Well, you gave us a ton to think about. It was different and what I like to call whiplash, because anyone who goes on these atomic level deep dives with me sometimes gets cognitive whiplash. Like they hear one thing from a guy they really know is smart and then sends them down one path, and they hear something from you and they go, oh, wait, maybe I got a question. That's the whole point of these conversations in public and in the feed, is to make us all sharper together and figure out where the truth of town actually is by what those comments and discourse lead us to. So I want to thank you for being on the atomic level. We'll have to have you back either closer to the end of the year or maybe early in the new year, see how it played out, and and check back in, and hopefully your list will continue to grow at the clip it is and be double, triple where it is right now. So guys, thank Danny for showing up. Danny Dayan on the atomic level. You can hit subscribe if you're on the live stream. You can just hit the button and subscribe to him. If you're not, when you get the replay, you'll have the ability to do that. I encourage y'all to do it. He's writing some great stuff, and obviously every Sunday gives the playbook away. So if you're looking for a playbook or something else to round out your own thinking, uh, check him out. And thanks for being on, buddy. And I look forward to seeing your stuff in the future as well, and sharpening my own thesis.
Thank you so much for having me. It was a great discussion. Glad we had, the ability to talk about some of the aspects of my background, to bring that into to give people a picture on what I do. And obviously this is a very, very interesting macro environment, being able to talk about what's going on. Hopefully it was helpful to people. I'm always happy to talk to anyone who needs, guidance. Please get in touch on the Substack, join our community. We have an active trading chat room where we talk about, the short-term dynamics as they're happening every single day. So thank you so much for having me on, and I would love to come on again. It'd be great. Thank you again.
Well, I'm going to end it with this. So in doing this kind of work, there is a thing called love, because I love what I do. I love meeting guys like you. I love having a conversation open in the public and not knowing where it's going to go. I love all of that. But as you know, and the rest of the world knows, in tennis and in markets, love means zero. And Danny, you were the exact guest to prove that point today. So everybody enjoy the rest of your afternoon. Thanks for being here live.